Welcome to the deep dive. Today we're digging into something that feels really backwards about building wealth.
That's right. It's this idea that when you're investing, trying less hard might actually be the best way to, well, end up with more.
Sounds strange, but we're looking at principles from people like Warren Buffett. The idea is that for most folks, maybe even professionals, investing can be a loser's game structurally.
Exactly. And we're going to unpack that using a famous parable, sort of a story, that really shows why cutting activity, cutting costs, is maybe the real secret sauce.
Okay, so let's talk about this story. It's about the fictional Gottschalk's family, huge family. And when they started out, they basically owned like 100% of all the stocks in the U.S.
Think about that. They owned the entire American corporate pie,
Wow.
which meant automatically they got 100% of all the dividends, all the earnings growth, everything.
So it was a perfect setup, a real winner's game, because there were no costs, nothing eating away at their returns.
Precisely. Zero friction. But that didn't last long, did it?
No, of course not. Enter the helpers. First up were the brokers. You know, the fast-talking types.
Right. And they convinced some of the Gottschalk's cousins to start trading shares with each other.
And suddenly, bam! Commissions start getting paid out of the family's pot, and taxes on the trades, too.
Yeah, that perfect 100% shares start shrinking right away. But it gets worse, much worse.
How so?
Well, when just trading didn't magically boost returns, they thought, we need experts. So they hired professional money managers.
Okay, sounds logical, but I sense a catch.
The catch was fees, big management fees.
Yeah.
And these managers, well, they felt they had to do something to earn those fees.
So they started trading like crazy.
At feverish levels, is how our source puts it, which meant even more brokerage commissions and a bigger tax hit for the family. Costs just kept piling up.
Okay, so the managers are trading a lot, costing a lot, and probably not even beating the market, right?
Often no. So what do you think the family did then?
Oh no, don't tell me they hired more helpers.
You guessed it. They hired investment consultants and financial planners, whose job was to pick the managers.
Seriously, fees on top of fees on top of fees.
Exactly, layer upon layer. And the end result, that original 100% ownership of the pie.
How much was left?
According to the story, it dwindled down to just 60%.
60. So 40% of their potential wealth just vanished.
It vanished into fees, commissions, unnecessary taxes, basically, the cost of all that activity.
That's staggering. So what was the solution in the story?
Well, there was this wise old uncle figure, and his advice was incredibly simple.
What did he say?
He said, get rid of all your helpers. Just stop. Go back to the start.
Go back to just owning everything and doing nothing.
Exactly. Hold all the stocks, Sam Pat, as he put it.
Yeah.
Which, interestingly, is pretty much exactly what a low-cost index fund does for you today.
Huh. Just own the market and sit tight.
It ties straight into Warren Buffett's idea, his law of motion for investing. The more activity, the lower the returns for investors as a whole.
It's a total conflict of interest then, isn't it? The financial industry wants you to do something because that's how they make money.
Right. But for you, the actual investor trying to grow wealth, the better advice might just be, don't just do something, stand there.
But hang on, surely sometimes you need experts, right? To navigate tricky markets or pick winners? Isn't that what people pay for?
You'd think so. But the hard data tells a different story. Jack Meyer, who ran the Harvard Endowment very successfully for years,
Yeah, what did he say?
he basically called the active investment management business a giant scam.
Wow, strong words.
And he had the numbers. He found something like 85 to 90% of professional managers fail to even match their basic benchmark index, like the S&P 500.
85 to 90% fail. Why?
Because they're deleting value, as he put it, through the very fees and trading costs we've been talking about.
And there's academic proof, too.
Oh, yeah. Professor Burton Malkiel from Princeton, he's shown this for decades. Index funds consistently beat most active managers.
By how much?
By close to 2 percentage points a year, on average. And that difference, it's almost entirely down to the lower expenses and lower trading costs of the index fund. Active management starts with a handicap.
So if we zoom out, the big lesson here seems to be it's all about the costs, minimizing those middleman layers.
That's pretty much the core of it. Successful investing isn't necessarily about finding the next genius stock picker. It's more about reducing that friction, the cost of financial intermediation, so you keep more of the market's actual return.
Intermediation just means all those helpers taking a slice, right?
Exactly. An index fund, basically, lets you play the game at par.
Yeah.
You get the market's return minus just tiny, tiny costs to run the fund itself.
Okay, so the evidence seems overwhelming. Low cost, low activity, like an index fund, guarantees you pretty much the market return.
Guarantees you play at par, yes.
Right. So here's the final thought for you listening. If the evidence is so clear that just standing pat works best for most people, why do so many investors keep chasing expensive active strategies that fail, 85–90% of the time?
What is that deep psychological pull? It's something to really think about. Maybe the next time someone offers to be your helper.
Welcome to the deep dive. You've sent us the sources, and our mission today is really to cut through all that market noise you hear constantly.
Yeah, that day-to-day chatter.
Yeah.
We want to zero in on the essential link, the connection between how businesses actually perform long-term and what you as a shareholder ultimately earn.
It sounds straightforward, but it gets lost so easily.
It really does. And it starts with a core idea, something Warren Buffett famously called the Gottschalk principle.
Ah, yes, the Gottschalk family.
Exactly. His point was simple. The most that owners in the aggregate can earn is what their business in the aggregate earns. Basically, shareholders altogether can't magically get richer than the underlying businesses they own over the long haul.
Right. If the businesses earn 5%, the owners collectively aren't going to get 10%. Seems logical.
It is. But you look at the headlines, the short-term swings,
Mm-hmm.
it makes you forget.
And there's solid history backing this up, isn't there? Looking back, say, from 1900 to 2005.
Yeah, a really long stretch. Over that whole period, the average annual total return from the stock market, what people saw reported, was about 9.6%.
Okay, 9.6%.
But here's the fascinating part. The actual investment return, the return generated purely by the businesses themselves, so their dividend payouts plus their earnings growth.
The real economic engine part?
Precisely. That came out to 9.5%, almost identical.
Wow. So that difference, just 0.1 percentage points, that's
Right.
market noise.
That tiny sliver is basically the impact of speculation, of emotion, over more than a century. And that's what we really need to unpack today.
But hold on, before we dissect that 0.1%, let's just appreciate the 9.5%. I mean, that's the power of compounding business value, right?
Absolutely. Think about it. $1 invested back in 1900, just based on that 9.5% business return, would have grown to over $15,000 by 2005.
That's incredible, just from companies doing their thing.
That's the fundamental reality. So if the business reality is the steady 9.5%, why does the market feel so wild sometimes? 20% up one year, down the next.
Yeah, where does that volatility come from?
Well, John Maynard Keynes actually broke this down really well. He said market returns have sort of a dual nature, two parts.
Okay, let's get into that. What are the two parts?
First, you have the investment return. That's the economic reality. We just talked about the dividends, the earnings growth. It's the intrinsic value building up steadily over time.
Right, the enterprise part, as he called it. Steady.
Exactly. And then you have the second part, the speculative return. This is all about the changing psychology of the market, investor emotion.
And how do we measure that emotion? Is that where PE ratios come in?
That's the main way, yeah. The
Yeah.
price to earnings, PE ratio. It just measures how much people are willing to pay today for $1 of a company's current earnings.
Okay.
And these ratios, they're like a thermometer for market mood. Really high PEs, that's often greed, or maybe extreme optimism, expecting huge future growth.
Like the dot-com bubble.
Textbook example. Then you have moderate PEs, that's maybe hope or just normal expectations, and very low PEs. That's usually fear taking over, like, say, in the mid-1970s.
So these emotional swings, the PE going up and down, that's what causes the big market swings that detach from the underlying business.
That's the driver of short-term volatility, absolutely.
Yeah.
You see it in bubbles, like the late 20s or late 90s, where prices get way ahead of the actual business results.
But how do we know it doesn't just stay detached? Why does it matter if the long-term reality is 9.5%?
Because it always gets pulled back. Think of it like gravity. Over that whole 106-year period we looked at, that entire speculative component, all the booms and busts as emotion, added only that tiny 0.1 percentage point per year to the total return.
Just 0.1%. That's staggering, actually.
It really is. It proves that over the long run, your success hinges almost entirely on the underlying business performance, that 9.5%. The rest is just noise.
So the daily stock market ticker, the ups and downs, it's largely a distraction from what actually matters for long-term wealth creation.
A massive distraction.
Yeah.
Roger Martin, the former dean at Rotman, he talked about two games being played simultaneously. There's the real market, companies making profits, paying dividends.
The business reality.
Right. And then there's the expectations market, where prices bounce around based on what investors think will happen next month, next quarter. Pure speculation, often.
Which really forces a question on you, the listener. Which game are you playing? Or maybe, which game should you be playing?
And that brings us straight to Benjamin Graham,
Yeah.
Buffett's mentor. He had that timeless analogy.
The voting machine versus the weighing machine.
Exactly.
Yeah.
In the short run, Graham said, the stock market is a voting machine. It reflects popularity, sentiment, emotion.
But in the long run, it is a weighing machine. It measures substance, the actual weight of the business's earnings and dividends.
Perfect. And that led to his other great analogy, Mr. Market.
Ah, yes. Your emotional business partner.
Right. Imagine this partner, Mr. Market, shows up every single day. He offers to buy your share in the business or sell you his, but his prices are all over the place. Some days he's euphoric and offers a crazy high price. Other days he's terrified and willing to sell dirt cheap.
And Graham's point was, you don't have to transact with him.
Precisely. The intelligent investor should ignore his daily moods. Focus on the actual performance of the business you own, the dividends coming in, the operating results. You use Mr. Market's occasional silly low prices to your advantage, perhaps, but you ignore the noise.
So, stepping back, all this short-term market frenzy, it really is like Shakespeare said. A tale told by an idiot, full of sound and fury, signifying nothing. It just distracts from the real job.
It absolutely does. The core takeaway here is pretty clear. Trying to predict short-term market emotion, the speculative swings, that's basically impossible, a fool's errand. But focusing on understanding and forecasting the long-term economics of the businesses you invest in, that carries, as one source put it, remarkably high odds of success. You're dealing with business reality, not fleeting psychology.
Okay, so here's the final thought for you to ponder. If long-term success really comes down to analyzing the business, the corporate enterprise, not guessing stock prices, what single metric of that business reality, maybe it's sustainable dividend growth, maybe consistent earnings power, should you be focusing your analysis on today? Forget the market headlines. What business fundamental matters most to you? Welcome to the Deep Dive. Today, we're looking at a bunch of sources aiming to really cut through the noise on investment strategy.
Right. And the goal, our mission, you could say, is to find that simplest solution, the one that, well, the numbers say guarantees you win the investment game.
Okay, so the simplest solution, what's the foundation here?
It starts with this idea, just cast your lot with business. Basically, own a piece of every single business in the U.S. Buy the market.
The whole market.
The whole market.
Yeah.
And then, crucially, hold on to it forever, ideally. That's how you guarantee you capture the return business generates over the long haul.
I like the directness. It's simple. And that simplicity, it actually reminds me of William of Ockham, way back in the 1300s.
The razor, exactly.
Right. The idea that if you have multiple ways to explain something, the simplest one, the one with the fewest assumptions, that's usually the right one.
Precisely. So in investing, forget the complex timing strategies, the stock-picking gymnastics.
Yeah.
Just choose the simplest path.
Which means, practically speaking,
Holding the total stock market portfolio. That's the Occam's razor solution for investing.
okay, let's get practical then. How do you actually measure or hold the total market? I mean, for years, everyone talked about the S&P 500.
Yeah, the S&P 500, created back in, 1926. It tracks the 500 biggest U.S. companies, represents about 80% of the total market value. It's been the benchmark forever.
But it's not the whole market.
No, not quite.
Mm.
For that, you look at something like the total stock market index, maybe the Wilshire 5000. That came later, around 1970.
And that includes how many stocks?
Way more. Almost 5,000 stocks last I checked. Around 4,971. It's designed to be the broadest measure possible.
Okay, 500 versus nearly 5,000. That sounds like a huge difference. But here's the really interesting part I found in the sources.
You mean the returns?
Exactly. Despite that massive difference in the number of stocks, their performance is almost identical.
It's pretty amazing, isn't it?
Yeah, look at the long-term data, say 1928 to 2006. S&P 500 returned 10.4% a year. The total market, 10.2%.
Practically the same. The correlation between them is something like 0.98. Super, super high.
Which tells you
Right.
you don't actually need every single tiny stock to capture the market's return.
Pretty much. Get the big guys, the bulk of the value, and you're basically there. You've captured the market's essence.
Okay, so that sets the stage. Owning the market, whether through S&P 500 or a total market index, gives you the market return. But why is indexing guaranteed to win against people trying to beat the market?
This is the crucial point. It comes down to arithmetic. See, the total return earned by all investors, as a group, must equal the return of the market itself. Before costs, anyway.
Right, because collectively all investors are the market.
Exactly. So owning the market itself, that's a winner's game. You get the market return. But trying to beat the market, active management, that's what we call a loser's game.
Why a loser's game if the gross returns are the same? Is it just fees?
It's overwhelmingly the costs, these intermediation costs. Think high management fees, broker commissions, the cost of frequent trading, all things index funds largely avoid.
So the active managers, as a group, start with the market return.
And then they subtract their costs, sometimes huge costs. So their net return, what you, the investor, actually keep, it has to be less than the market return captured by a low-cost index fund. It's mathematical certainty.
Okay, that makes sense. It's not about being smarter, just cheaper. So that quote from the sources really lands. If the data do not prove that indexing wins, well, the data are wrong.
It sounds bold, but the arithmetic backs it up. And the history, too. Look at the S&P 500 versus typical actively managed large-cap funds, say from 68 to '06.
What did that show?
Consistency. The S&P 500 index beat the average active fund in 26 out of 35 years. On average, it ranked better than 58% of the active funds. It wasn't always number one, but it was consistently above average year after year.
And that consistency compounds over time.
Massively. And it's not just small investors noticing. You've got heavy hitters validating this. David Swensen, the legendary guy from Yale's endowment.
Yeah, what did he say?
He pointed out that maybe only 4% of active funds manage to beat the market after taxes, and the other 96%. They don't just fail, they fail by a wealth-destroying margin, losing about 4.8% per year compared to the index, mostly due to costs and taxes.
Wow, 4.8% a year? That's a huge drag.
It's enormous, and that's why you see indexing as a core strategy now for giant retirement plans. Think the Federal Thrift Savings Plan, hundreds of billions manage it this way? They rely on simple, low-cost indexing.
So bringing it home for the listener, what's the practical takeaway? There was a story about the first index fund.
Right, the Vanguard 500 Index Fund, launched in 1976. If you put $15,000 into it back then,
Yeah.
by 2006, just holding on, doing nothing, it grew to over $461,000.
Just by owning the market and keeping costs low.
That's the power of simplicity and compounding. It confirms the whole thesis. Why make it complicated? Why chase rainbows with complex, costly strategies?
When Occam's razor points to the simplest path.
It's being the most effective, the most productive, and definitely the most consistent. You don't need to find the needle in the haystack. Just buy the whole haystack.
Welcome to the deep dive. Today, we're cutting straight to the chase. The basic math behind investing success, or often why it's so hard to achieve.
That's right. We're looking at what our sources call the relentless rules of humble arithmetic. Simple math, really.
And these rules, they explain why most investors, well, as a group anyway, don't actually get the full market return.
Exactly. It starts with a couple of, financial certainties. The first one, beating the market before you factor in any costs, that's a zero-sum game.
Meaning for every dollar someone gains above the average, someone else has to lose a dollar relative to that average. Simple pairing off.
Precisely. Which brings us to the second certainty, and this one really hits home for you, the investor.
Okay.
If beating the market before costs is zero-sum, then trying to beat it after costs, that has to be a loser's game mathematically.
A loser's game. That's stark. So basically the house always wins, in a manner of speaking.
Well, the house in this case is the financial system, the brokers, the managers, everyone taking a slice. All investors together earn the market's gross return. But then costs get subtracted.
And that means the net return for investors as a group absolutely must be lower than the market return. There's no way around it.
It's unavoidable. So
Yes.
let's break down those costs. This cost avalanche you mentioned.
Right. So if I look at a typical actively managed stock mutual fund, I see the expense ratio, maybe 1.5% a year for management fees, operating costs. Seems okay.
It seems okay on the surface. But the sources point out this huge hidden cost, portfolio turnover.
Turnover, you mean how often they buy and sell stocks within the fund?
Exactly. And the average equity fund turns over its entire portfolio roughly once a year.
Right.
100% turnover rate.
Wow, 100%. That sounds frantic and expensive.
Very. That constant trading creates friction. Think brokerage commissions every time they trade.
Yeah.
Then there's the bid-ask, spread that tiny gap between buying and selling prices.
Mm.
And also market impact. Big funds making big trades can actually push the price against themselves slightly. Add it all up.
And what's the estimate for that hidden friction cost?
Our sources estimate it's easily a full 1% per year, on average. on top of the expense ratio.
So now we're talking 1.5% plus another 1%. That's 2.5% right there.
And sometimes more. The total all-in cost could be closer to 3%, maybe even 3.5% annually for owning that average active fund.
That is a significant drag year after year. It really drives home that quote, doesn't it? We investors get precisely what we don't pay for.
It does. Pay nothing, in theory, you get everything the market offers. Pay a lot, well, you get a lot less.
And the real damage happens over time, right? Compounding.
Oh, absolutely. Costs compound just like returns do, but in the wrong direction for you. This is where the tyranny kicks in.
Let's use that example from the sources. Say you invest $10,000 for 50 years. The market average is 8% a year.
Okay, without costs, that $10,000 grows to about $469,000. Pretty amazing. The miracle of compounding returns.
But now let's factor in the average fund. It earns that 8% market return, but then you subtract, say, 2.5% in annual costs. So you're netting only 5.5%.
Right. And over 50 years, that same $10,000, netting 5.5%, it only grows to about $145,400.
Wow. $145,400 versus $469,000. That's a difference of $323,600.
It's staggering. Look at it this way. Costs ate up nearly 70% of your potential accumulation. You took all the risk.
And the system took most of the potential reward. That phrase really hits. The miracle of compounding returns is overwhelmed by the tyranny of compounding costs.
It truly is. And this isn't just a hypothetical. Let's look at some real-world data.
Okay, the period 1980 to 2005, what did the stock market itself do? The S&P 500 index.
It averaged 12.5% per year over those 25 years. Solid returns.
And the average actively managed U.S. equity fund during that same time?
Average only 10.0% per year.
There it is again, that 2.5% gap, just like the math predicts.
Exactly. The costs show up in the final numbers. Now compare that to a simple low-cost index fund designed just to track the S&P 500.
Right, those have minimal costs, maybe 0.2% per year or even less now.
So that index fund would have returned about 12.3% per year, just the market return minus those tiny costs.
And what does that mean in dollar terms over 25 years, starting with $10,000?
Big difference. The index fund investor saw their $10,000 grow by about $170,800.
Okay. And the average active fund investor?
Their $10,000 grew by only $98,200.
So the active fund investor got just 57% of the wealth accumulation that the index fund investor achieved, just over half.
That's the power of minimizing costs. And, it's why you hear famous active managers eventually kind of can see the point. Peter Lynch.
Yeah, legendary manager at Fidelity Magellan. What did he say?
He basically said the public would likely be better off just using an index fund.
Even Jim Cramer from Mad Money.
Even Cramer admitted the arguments for indexing were so strong, he was tempted to just join them instead of trying to beat them. When the pros struggle, it tells you something.
It really underscores that Upton Sinclair paraphrase, doesn't it? It's amazing how difficult it is for a man to understand something if he's paid a small fortune not to understand it.
Exactly. The industry is built on fees. Your success is built on avoiding them as much as possible.
So, wrapping this up for you, the listener, what's the key takeaway here?
It's simple, really. Costs are paramount. They likely make the difference between reaching your financial goals and falling short.
You have to look out for yourself. You have to, as you said, do your own arithmetic.
Absolutely. And maybe keep that quote from Justice Brandeis in mind. Not just for investing, but for, well, many things. Remember, arithmetic is the first of the sciences and the mother of safety.
Use that math. It protects you. Some fundamental wisdom to consider.
Okay, let's dig into this fascinating topic we're calling the grand illusion in investing today. Our goal really is to unpack a crucial difference, one that's often missed, between two types of investment returns. We're talking about the returns mutual funds report. That's the time-weighted return, basically measuring the fund's own performance, versus the returns investors actually get in their pockets, which is the dollar-weighted return. That one accounts for, when money moves in and out.
Exactly. And this isn't just some academic footnote. It's actually fundamental to your long-term wealth accumulation. We already know fund returns tend to lag the market because of costs, right? But the sources we've looked at, they show the real shocker comes from investor behavior. It creates this whole secondary cost that, well, it just crushes returns over time.
Right, the behavior gap. So let's look at the data, because it sounds pretty stark. The period is 1980 through 2005. And the numbers are, a basic stock market index fund returned 12.3% per year. The average actively managed equity fund, that reported 10.0% a year. So already a gap there just from fees and maybe underperformance. But I'm guessing the investor numbers where it gets really painful.
That's the core aha moment, absolutely. The average fund investor, the actual person putting money in and taking out, they only earn 7.3% annually. That massive 2.7 percentage point lag each year behind even the fund's reported return. It's almost entirely down to timing. It's capital flowing in after the good times, chasing performance, and then rushing out after the market tanks.
Wait, hold on. So even if the fund itself managed a decent 10%, the investor managed to talk themselves down to just over 7%. That's wow. And when you compound that over 25 years, what does that look like in actual dollars? Okay,
Yeah.
so $10,000 in the index fund grows to $170,800. Makes sense. But the average fund investor, their $10,000 only grew to $48,200. That's less than the third. They captured only about 28% of what the simple index offered. That's just staggering.
It is staggering, and it really begs the question, why? Why does this keep happening? The sources we reviewed point squarely at two big behavioral mistakes. Really bad market timing and let's call it unwise fund selection, chasing hot dots.
And there's data on that timing, right? Like how much money flowed in at the wrong times. Okay, get this. In 1990, when stocks were arguably cheap after a downturn, investors only put a net $18 billion into equity funds. $18 billion. Compare that to 1999 and 2000, near the top of the tech bubble. They poured in $420 billion, buying hot.
Precisely. And the selection problem compounded it. At that same market peak, around 99-2000, a whopping 95% of all the money flowing into funds went into the riskiest category, aggressive growth funds. That was up from maybe 20% earlier in the decade. Everyone piled into the hottest, most volatile stuff right at the top.
Wow. So bad timing and choosing the riskiest funds at the peak, what did that actually do to returns? Is there a specific example?
Yeah, there's a case study on those aggressive growth funds specifically, looking at 1996 to 2005, a 10-year period that included the boom and bust. Over those 10 years, the funds themselves, on paper, reported a 7.8% annual return. Not amazing, but acceptable, right?
Okay.
But the average shareholder in those funds, their actual return was negative 0.5% per year.
Negative. They lost money.
They lost money over a decade. That's a cumulative gap, a performance penalty of over 117 percentage points compared to what the fund itself reported.
So chasing those hot funds literally costs them their principal and then some, even while the fund technically had positive returns on paper. Incredible.
And the root cause, when you boil it all down, it's pretty simple. It's investor emotions. Fear and greed, often amplified, frankly, by how the fund industry markets itself, highlighting recent winners.
Okay, so this paints a pretty bleak picture for active fund investors trying to time things. What's the takeaway? What should people actually do?
Well, the solution that comes through loud and clear from the sources is it's boring but effective. It's indexing and discipline. Meaning, set a sensible strategy, like owning the whole market through a low-cost diversified index fund, and then just stick with it. Through thick and thin, don't react to the headlines.
Right, stay the course. And this isn't just our conclusion, is it? There are some heavy hitters who agree.
Absolutely. Warren Buffett famously talks about the enemies of the equity investor being expenses and emotions, the two big E's. And Charles Schwab, his rationale for indexing was basically, look, the predictability of getting good, not necessarily top, but good, consistent returns is so high with indexing. Why would you mess it up trying to beat the market?
So the bottom line for you, the listener, seems pretty clear. Forget trying to pick the next hot fund or jump in and out of the market. The real path to success, according to this evidence, is just owning the whole market cheaply through something like an index fund and letting compounding do its work. Basically, do nothing.
Yeah, and maybe a final thought to leave you with, since we know investors tend to lag even their own funds because of these emotional timing mistakes. Take a hard look at your own approach right now. Are you, perhaps unknowingly, chasing yesterday's winners? And more importantly, what concrete steps can you put in place now? Maybe automating investments, writing down your plan to make absolutely sure you'll stay the course the next time the market gets choppy and your gut screams sell.
Okay, let's dive back in. We've covered investment costs, the expense ratios, and also that constant drag from inflation.
Right, those first two relentless rules eating away at returns.
Exactly. So now our sources bring up the third major penalty facing investors, income taxes. We're talking federal, state, and local taxes here.
And it's really important to set the stage here. If you, listening, have all your investments tucked away in tax-deferred accounts like IRAs or 401ks, this discussion is less critical for you right now.
Good point. But for many people, almost half of equity fund shares are actually held in fully taxable accounts.
And for those accounts, the data our sources present paints a pretty stark picture. Managed mutual funds, they're labeled as astonishingly tax inefficient.
Astonishingly inefficient. Okay, so why? What makes them so bad from a tax perspective? The material seems to point towards, well, managers trading too much.
That's pretty much the core issue. It's the focus on the short term. Active fund managers, they're often measured on quarterly performance, leading to this hyperactive trading.
And that generates realized gains.
Precisely. Realized capital gains. And we see it clearly in the turnover numbers. The average equity fund today turns over its portfolio about 100% per year.
Wow, 100%. So the typical stock is only held for, what, about a year?
Just about 12 months, yeah. Compare that to, say, the period between 1945 and 1965. Back then, turnover was way lower, maybe 16%.
So stocks were held for 6 years on average. Much
Longer. And when a fund is constantly buying and selling, realizing those gains quickly, it creates immediate tax obligations for the shareholders. You get hit with taxes even if you personally haven't sold a single share of the fund.
Right, whereas the index fund strategy is the total opposite. Buy and hold, basically forever.
Minimal trading, minimal transaction costs, and crucially, minimal realized taxable gains.
Okay, so turnover is the engine driving the tax inefficiency. Let's put some numbers on that. How bad is the damage from this short-term focus after taxes?
This is where the comparison really hits home. The sources look at a 25-year period from 1980 to 2005. The average actively managed fund, it returned about 10.0% per year before taxes.
Okay, 10% pre-tax. But taxes took a huge bite, right?
Huge bite. The estimated annual federal tax drag was around 1.8 percentage points. That knocked the actual after-tax return down to just 8.2%.
1.8 points just for federal taxes each year? Ouch. How did the index fund compare?
Well, the index fund actually had a higher pre-tax return in that period, 12.3%. But its tax drag was much, much lower, only about 0.6 percentage points per year.
So 12.3% pre-tax becomes 11.7% after-tax for the index fund.
Exactly. The active fund lost nearly 3 times as much return to taxes each year compared to the passive index fund.
In over 25 years. That difference must be massive in terms of actual money.
It's staggering. If you started with $10,000, in the average active fund, after 25 years and after taxes, you'd have about $61,700
Okay.
in the index fund. That same $10,000 grew to about $149,000 after taxes.
Whoa, so more than double the wealth just because of lower costs and better tax efficiency on the capital gain side.
Primarily, yes. The tax efficiency on gains is a huge factor.
But, the sources point out something really interesting here, almost a paradox. When you look specifically at dividend income, it flips, doesn't it?
It does seem to flip, but the reason why is, well, it's all about the costs again. Think about it. Let's say the stocks in both funds pay out a gross dividend yield of, say, 1.8%.
Okay, 1.8%.
Now, the typical active fund has high expenses, right? Maybe around 1.5%.
Right, we covered that. High fees.
So that 1.5% expense ratio basically eats up most of the 1.8% dividend before it can even be distributed to you, the shareholder.
Well, hang on. So the active fund pays less tax on dividends because its own high fees consumed like 80% of the dividend cash flow first?
That's exactly it. They only distribute the tiny remainder, maybe 0.3%, so there's less income to tax. It looks tax efficient on paper regarding dividends, but only because the fund manager took most of the cash first.
Huh. Okay. Well, the index fund.
The low-cost index fund, with maybe 0.15% expenses, passes almost the entire dividend through. So out of that 1.8% gross yield, you get maybe 1.65% as a net yield distribution.
More cash in your pocket, but yes, that larger distribution is then taxed.
Correct. But you'd rather receive the income and pay tax on it than have the fund manager essentially confiscate it via high fees, right?
Definitely. So putting it all together, the expenses, the inflation, and now these taxes, the consensus seems pretty overwhelming against active funds in taxable accounts.
It really is. Our sources quote investment advisor William Bernstein, who put it very bluntly. He said it's truly a terrible idea to own actively managed funds in taxable accounts.
And he mentioned taxes could be a drag of up to how much?
He estimated it could be up to 4 percentage points annually in some cases. It's often the final nail in the coffin for active management's after-tax performance.
Okay, so we focused on the annual tax hit. But the material hints at one last sort of loophole for long-term index fund investors in these taxable accounts. A way to potentially avoid capital gains tax forever.
Yes. The ultimate deferral and then elimination. There's one specific scenario where all the accumulated capital gains, potentially decades of growth, might never be taxed.
So what's the final thought for listeners to consider? What is that scenario?
It involves what happens when you pass away and leave those shares to your heirs. There's something called a step-up in basis. Essentially, the cost basis for your heirs becomes the market value on the date of death.
Meaning, all the gains during your lifetime are just
Mm.
wiped away for tax purposes for them.
Exactly. They could sell the shares the next day and owe zero capital gains tax on all that appreciation that happened while you owned the shares. It's a powerful estate planning aspect of buy and hold investing in taxable accounts, something definitely worth considering in your long-term strategy. Welcome to the deep dive. Today, we're really digging into the U.S. stock market's core arithmetic. For the last quarter century or so, the market gave us this amazing 12.5% nominal annual return. Our mission today, figure out where that came from and maybe more importantly, why that era seems to be over.
Right, because there's this unfailing principle, you could call it. It basically says long-term stock returns have to line up with the business reality. So, dividends paid out plus the growth in corporate earnings.
Okay.
And historically, if you look back over a century, the total nominal return was more like 9.6%.
So hang on. The last 25 years gave us almost 3 full percentage points more than that long-term norm. If the business reality dividends and earnings stayed roughly the same, where did that huge extra boost come from?
Oh, well, that's the kicker.
Oh,
It
no.
was almost purely speculative return.
Right.
What's really fascinating here is the underlying investment return. That was actually pretty normal, came in at 9.8%, right in line with history, more or less. The explosion, the real anomaly, came from just one thing, the price-to-earnings ratio, the PE. It essentially doubled over that period, went from about 9 times earnings way up to 18 times.
Doubled. So let me get this straight. It wasn't necessarily that companies were making twice the profit to justify that. It sounds like people just became willing to pay twice as much for the exact same dollar in earnings.
That's precisely it. Yeah. That's the magnification effect of speculation right there, that PE expansion. It added 2.7 percentage points every year to the total return,
Wow.
making speculative gains responsible for, over 20% of that big 12.5% average number.
Hmm.
And, common sense tells you it's just highly unrealistic to expect the PE ratio to double again, right? From 18 up to 36.
Yeah, seems unlikely. So that speculative era is basically done.
Functionally over, yeah.
Which, okay, that sets us up for what you called an era of subdued returns. But I have to ask, the PE's been sitting around 18 for a bit now. Why do we have to assume it must go down? Couldn't 18 just be the new normal?
Well, it could be, theoretically. But even if it stayed at 18, we're still facing some pretty major headwinds. Just look at the dividend yield. It's an immediate kind of baked-in loss compared to history.
How so?
Historically, the average dividend yield was like 4.5%.
Yeah.
Today, it's struggling to stay near 2%, sometimes below. So right there, that's an immediate ongoing deadweight loss of about 2.5 percentage points a year, before we even talk about PRE changes.
Okay, that's a huge drag already. So if we figure maybe corporate earnings grow roughly with the economy of, say,
Yeah.
5 or 6% nominal growth at the current lower dividend yield, that puts our core investment returns somewhere around, what, 7 to 8%?
Exactly, that's the baseline. Now, add in the PE factor. Let's say PE doesn't crash, but maybe just, eases off a bit. From 18, maybe down towards 16 times. That's just a nervous guess, really, but if that happens,
What does that do?
it shaves off another full percentage point from the annual return.
Yeah.
So you take that 7-8%, subtract 1%, and you land right around 7% for the total projected nominal return. And, we're not alone in thinking this. Morgan Stanley strategists, others, they're putting out forecasts in that ballpark, like 6.5% to 6.6%. It's kind of the consensus now.
Right. Okay. 7%. Let's talk about what that means for investors, especially regarding costs. Because moving from a world where you expected 10% to one where you expect 7%,
Yeah.
well, the math on investment costs gets pretty brutal, doesn't it?
Oh, it's absolutely lethal. That magnification effect works in reverse, too. Think about it. When returns were 10%, maybe your fund costs were 2.5 percentage points. That ate up 25% of your return. Manageable, maybe.
Okay.
But in a 7% world, those same 2.5 points in costs now consume almost 40% of your entire potential gain.
40%. Wow. Okay. And this leads to that really shocking projection in the source material we looked at. If 7% is the rational market expectation, the average actively managed equity fund, after you account for costs and taxes and inflation, their projected real annual return is, what was it?
A mere 1.4% per year.
1.4%. Wait,
Yeah.
that's barely beating inflation, maybe not even beating a good savings account some years. That's just shocking, really, for active management.
It really is. And there was that data nugget comparing funds, too, right? On a $10,000 investment over 10 years, a simple low-cost index fund is projected to give you about $5,100 in real gains.
Okay, decent.
The typical actively managed fund, after all the costs and things, just $1,500.
1,500 versus 5,100. That's stark.
It's a huge difference, yeah.
So wrapping this up, what's the ultimate takeaway here for you, the investor, listening to this?
Well, the conclusion seems pretty clear. In this likely future of lower stock market returns, that relentless arithmetic of high fund costs, it makes the typical actively managed fund, and I quote, a singularly unfortunate investment choice.
Singularly unfortunate. That's quite a statement.
Yeah.
So, okay, since a 1.4% real return is probably unacceptable for most people saving for the long term, the source material actually lays out 5 different strategic options investors could consider. So we'll leave you with this thought. Which of those 5 strategies might be the most effective defense against this ruthless arithmetic trap we just discussed? You might even be doing it already.
Welcome to the Deep Dive. Today we're tackling what might just be, well, the hardest question in investing. How do you pick a mutual fund that's actually going to win, over the long term? Our mission today is to cut through the hype. We're diving into the cold, hard numbers from this huge 35-year study, looked at 355 equity funds starting way back in 1970 all the way to 2005. And we're starting with a real shocker, like right off the bat. Of those original 355 funds, get this, 223 of them, nearly 2/3, just went out of business, gone. I mean, you want to invest for 30 years, right? But if the fund itself doesn't even survive, well, your plan's kind of dead on arrival.
That's exactly the challenge, isn't it? It really shows why predicting which funds will stick around and do well is so much tougher than just looking back and saying, oh, that one was a winner.
We can probably guess the really bad ones disappeared, sure. But the reasons are, well, messy. Funds don't just vanish because of bad stock picks. Sometimes a great manager leaves, or the fund gets bought out, merged away, or, maybe investors just get fed up after a few average years and pull their money out. The market is pretty brutal about pruning those underperformers.
Okay. Let's drill down into those numbers for you listening. So we start with 355 funds in 1970. Then, boom, 223 are just gone, non-survivors. Then of the ones left, another 60 were still around, but basically losers. And losers, meaning they lagged the S&P 500 by more than 1% a year. Why is that 1% mark so significant? Well, that 1% hurdle is often a pretty good indicator. It often means that after you account for the funds fees, its trading costs, all the admin stuff, any tiny edge they might have had got eaten up. So if you add up the ones that vanished, plus the ones that couldn't even clear that basic 1% hurdle compared to the index, you get 283 funds. That's almost 80%.
Right.
80% of the initial group either disappeared or just, well, disappointed. The odds are, frankly, terrifyingly stacked against you if you're trying to pick an active fund.
Right. So after 3.5 decades, only 24 funds, like 1 out of every 14, managed to beat the market by more than that 1%. Just barely.
Yeah.
And the real stars. The ones beating the S&P 500 by 2% or more year after year, that group shrinks down to just 9 funds, 9 out of 355.
And here's where it gets really interesting, because even among those 9, you hit what's called the winner's curse. 6 of those 9 super elite funds, well, their amazing records eventually turned kind of lackluster. Why? Mostly because they got too big. There's that saying, right? A fat wallet is the enemy of superior returns.
Well, when a fund gets massive, billions and billions, the manager just can't be nimble anymore. They can't easily buy into smaller companies, and even getting in or out of large stocks without affecting the price becomes a real challenge.
Yeah, you see that with the big names, like Peter Lynch at Fidelity Magellan. Incredible run, right?
Yeah.
But after its peak, the fund struggled for, 13 years? Partly because it just got so enormous. But wait, is it totally fair to just blame size? Doesn't huge scale also bring some, stability or resources?
It brings stability, yes, but often at the cost of that high return potential. Big ships turn slowly, To get those really outsized returns, managers often need that agility, that ability to move quickly, which makes the exceptions, the ones that did maintain excellence, even more remarkable, the true rarities. So you're saying only 3 funds. Just 3 out of the original 355 managed to survive and keep up that high performance over the whole 35 years. That's less than 1%. What were they?
Davis New York Venture, Fidelity Contra Fund, and Franklin Mutual Shares. Just those 3. And maybe the common thread, if you look closely, they tended to have pretty stable management, fewer changes at the top, but it really highlights how temporary excellence usually is. Think about Bill Miller at Legg Mason Value Trust. Famous streak, right? Beat the S&P 500 for 15 years straight, 91 through 2005. Unheard of. And then what happened in 2006? The streak ended badly. lagged the market by 10 percentage points.
Ouch. And there's a critical point here for you, the listener, isn't there? Legg Mason's reported average return during that streak was amazing, like 14.9%. But the actual return the average shareholder earned was way lower, only 10.3%. What explains that huge gap? That's almost 5% difference per year.
Yeah, that gap is crucial. It shows the difference between time-weighted returns, what the fund itself did, and dollar-weighted returns, what the investors actually got. The fund's return assumes you put $1 in at the start and left it. Simple. But the shareholder return reflects when people actually put their money in and took it out. And it's lower because most people didn't invest back in 91 when Miller started the streak. No, the big money flooded in around 97, 98, much later. Basically, people chased the hot performance. They piled in near the peak, not the beginning. Classic behavioral mistake.
Wow. So it perfectly illustrates that trap, doesn't it? Chasing past winners. The bottom line seems to be the odds of you, the listener, picking an actively managed fund that will consistently beat the market over decades. They're incredibly low, less than 1 in 100 based on this study. These funds that deliver sustained excellence are just, well, they're the exception, almost a statistical anomaly.
Exactly. Which leads us back to that inescapable conclusion from the great John Bogle. He basically said, don't waste your time looking for the needle in the haystack. His advice, just buy the haystack. Meaning, stick with a simple, low-cost, broadly diversified index fund. Own the whole market.
Right. And if the sheer math of it all doesn't quite convince you, just remember that warning label tucked away in every single fund prospectus. You know, the one nobody reads.
Yeah.
Past performance is no guarantee of future results. It really echoes what the economist Paul Samuelson pointed out, trying to find that one super performer, that 1 in 20, maybe even 1 in 100 outcome. It's kind of a fool's errand when owning the whole haystack offers such a reliable path. Makes you think.
नमस्कार। म्यूचुअल फंड चुनते समय ज़्यादातर लोग सबसे पहले क्या देखते हैं? अक्सर फंड का पिछला प्रदर्शन, है ना? खासकर अगर हाल में बहुत अच्छा किया हो।
हाँ, ये बहुत आम है।
तो आज हम इसी पर थोड़ी गहराई से बात कर रहे हैं। एक जानी मानी किताब है निवेश पर, द लिटिल बुक ऑफ कॉमन सेंस इन्वेस्टिंग, उसी के कुछ हिस्सों का आधार बनाकर।
अच्छा।
हमारा मकसद है ये समझना कि क्या सिर्फ पिछले प्रदर्शन को देखकर, मतलब खास तौर पर जो हाल में जबरदस्त रहा हो, क्या उसे देखकर फंड चुनना एक कामयाब रणनीति है?
ये सवाल तो बहुत अहम है।
और देखिए, एक दिलचस्प बात यह है, करीब 95% निवेशक अपना पैसा उन्हीं फंड्स में डालते हैं जिन्हें मॉर्निंग स्टार ने 4 या 5 स्टार रेटिंग दी है।
हाँ, ये रेटिंग्स बहुत पॉपुलर हैं।
और ये रेटिंग्स पिछले 3, 5, 10 साल के प्रदर्शन पर आधारित होती हैं। लेकिन ध्यान देने वाली बात यह है कि हाल के प्रदर्शन, मतलब पिछले 2 साल का वजन बहुत ज्यादा होता है इसमें।
अच्छा, कितना वजन?
जैसे 10 साल पुराने फंड के लिए करीब 35% और 3 से 5 साल पुराने फंड के लिए तो 66% तक। तो सवाल उठता है, क्या ये सितारे सच में भविष्य का रास्ता दिखाते हैं? चलिए जरा इसी गुत्थी को सुलझाते हैं।
हाँ, यहीं पर कहानी थोड़ी उलझती है। आंकड़े तो यही बताते हैं कि इन स्टार रेटिंग्स के भरोसे रहना कोई बहुत सफल रणनीति नहीं रही है।
ऐसा?
हाँ, मार्क हुल्बर्ट ने एक विश्लेषण किया था 1994 से 2004 तक का। उसमें पाया गया कि अगर कोई सिर्फ 5 स्टार फंड्स में ही लगातार पैसा लगाए रखता तो उसे सालाना रिटर्न मिला केवल 6.9%।
सिर्फ 6.9%?
हाँ, जबकि पूरे स्टॉक मार्केट इंडेक्स का रिटर्न था 11.0%।
अरे, ये तो काफी कम है।
बिल्कुल, और वो भी ज्यादा जोखिम उठाकर।
6.9 बनाम 11, ये तो बहुत बड़ा अंतर है, खासकर जब ये माना जाता है कि ये सबसे अच्छे फंड्स हैं। और ये रुझान तेज बाजार में, बुल मार्केट में शायद और भी खतरनाक हो जाता होगा।
बिल्कुल सही। 1997 से 1999 का जो नई अर्थव्यवस्था वाला बबल था, उसका उदाहरण देखिए।
हाँ, वो टेक बबल।
हाँ, उस दौरान जो टॉप 10 इक्विटी फंड्स थे, जिनमें ज्यादातर टेक्नोलॉजी और इंटरनेट स्टॉक्स भरे हुए थे, उन्होंने हर साल औसतन 55% का, मतलब हैरान करने वाला रिटर्न दिया।
55% सालाना?
हाँ, 3 साल में कुल 279%।
बाप रे, ये सुनकर तो कोई भी निवेशक कूद पड़ेगा। लेकिन दिक्कत यह है कि लोग ऐसा प्रदर्शन देखने के बाद ही पैसा लगाते हैं ना।
फिर क्या हुआ?
फिर वही हुआ जो अक्सर ऐसे बुलबुलों के साथ होता है, वो फूट गया 2000 से 2002 के बीच।
अच्छा।
और वो पुरानी कहावत सच हो गई, जो पहले थे वो आखिरी हो गए।
मतलब
वही टॉप 10 फंड्स अगले 3 सालों में औसतन 34% प्रति वर्ष नीचे गिरे।
ओह, 34% गिरे?
हाँ, हर साल औसतन। और हर एक फंड रैंकिंग में बुरी तरह लुढ़क गया। सोचिए, 891 फंड्स की लिस्ट थी।
हाँ,
उसमें कोई भी 790 रैंक से ऊपर नहीं था, और एक तो सबसे नीचे पहुंच गया 851वें स्थान पर।
सबसे नीचे? ये तो भयानक है।
लेकिन सबसे चौंकाने वाली बात क्या थी इसमें?
सबसे चौंकाने वाला था निवेशकों का वास्तविक अनुभव। देखिए, फंड्स का अपना कुल 6 साल का रिटर्न, जिसे हम टाइम वेटेड रिटर्न कहते हैं।
हाँ, जो फंड का प्रदर्शन मापता है।
सही, वो औसतन 13% सालाना था। सुनने में शायद बहुत बुरा न लगे।
हाँ, 13% तो ठीक ही लगता है 6 साल में।
लेकिन निवेशकों को असल में जो रिटर्न मिला, जिसे डॉलर वेटेड रिटर्न कहते हैं, जो ये देखता है कि पैसा कब आया और कब गया,
हाँ, असली अनुभव,
वो औसतन -57.5% था।
क्या -57.5%?
हाँ, मतलब जिन लोगों ने वो ऊंचे रिटर्न देखकर पैसा लगाया था, उनका आधे से ज्यादा पैसा डूब गया।
ओहो।
संदेश बिल्कुल साफ है। पिछले प्रदर्शन के पीछे भागना, खासकर तेज बाजारों में, बहुत ज्यादा जोखिम भरा हो सकता है।
-57%, ये तो बहुत बड़ा सबक है। तो इसका मतलब यही है कि जो फंड बहुत तेजी से ऊपर जाते हैं, वो अक्सर उतनी ही तेजी से नीचे भी आते हैं।
बिल्कुल, इसे मीन पर वापसी या रिवर्जन टू द मीन, RTM कहते हैं। ये एक बहुत शक्तिशाली सिद्धांत है।
अच्छा।
हाँ, इसका मतलब है कि जो चीजें औसत से बहुत ज्यादा अच्छा या बुरा करती हैं, उनमें वापस औसत की तरफ लौटने की एक प्रवृत्ति होती है। और ये सिर्फ बाजार के बड़े उतार चढ़ाव या बबल में ही नहीं होता, सामान्य समय में भी ये सच होता है।
तो ये सिर्फ किस्मत की बात नहीं कि टॉप फंड्स नीचे आ जाते हैं, सामान्य बाजार में भी ऐसे ही होता है।
हाँ, बिल्कुल। 2 अलग-अलग स्टडीज हुई, एक 1982 से 1992 और दूसरी 1995 से 2005।
जी।
दोनों ने यही दिखाया।
क्या दिखाया?
कि किसी एक साल के जो टॉप 20 फंड्स होते हैं, अगर आप उन्हें देखें,
हाँ,
तो अगले साल उनका औसत प्रदर्शन मुश्किल से औसत के आसपास ही रहता है। मतलब लगभग 57-58वां परसेंटाइल।
यानी 100 में से 57वें या 58वें नंबर पर।
हाँ, और दिलचस्प बात यह है कि दूसरी स्टडी में जो फंड्स नंबर 1 पर थे,
हाँ,
एकदम टॉप पर,
हाँ।
उनका अगले साल का प्रदर्शन सबसे खराब रहा, सिर्फ 34वां परसेंटाइल।
क्या बात कर रही हैं? नंबर 1 वाला अगले साल सबसे खराब में। ये तो वाकई कमाल है।
सही कहा। तो ये दिखाता है कि म्यूचुअल फंड की दुनिया की ये जो सितारे होते हैं ना, वो अक्सर सितारों की तरह टिकते नहीं, बल्कि धूमकेतु की तरह होते हैं। थोड़ी देर चमकते हैं और फिर बुझ जाते हैं। प्रदर्शन में क्या कहते हैं, रैंडमनेस या संयोग का तत्व काफी ज्यादा लगता है।
तो क्या इसका मतलब ये है कि फंड मैनेजर की कुशलता, स्किल, वो मायने ही नहीं रखती? सब किस्मत का ही खेल है?
देखिए, नसीम निकोलस तालिब का एक विचार है। वो सिक्का उछालने वाला उदाहरण देते हैं।
हाँ।
कि अगर हजारों लोग सिक्का उछालें, तो सिर्फ संयोग से ही कुछ लोग लगातार कई बार सही अनुमान लगा लेंगे।
अच्छा, हाँ, ये तो है।
तो इसी तरह हजारों फंड मैनेजर्स में से कुछ सिर्फ किस्मत के दम पर लगातार विजेता जैसे दिख सकते हैं। टेड एरोनसन तो यहाँ तक कहते हैं कि सांख्यिकीय रूप से ये साबित करने में कि किसी मैनेजर की सफलता स्किल की वजह से है, न कि सिर्फ किस्मत से, दशकों या शायद सदियां लग सकती हैं।
दशकों या सदियां? अरे बाप रे। तो फिर निवेशक क्या करें? मतलब निचोड़ क्या है सबका?
निचोड़ वही है जो जेसन ज़्विक कहते हैं, और मुझे लगता है बिल्कुल सही कहते हैं।
क्या कहते हैं वो?
कि सिर्फ पिछले प्रदर्शन के आधार पर फंड खरीदना शायद सबसे मूर्खतापूर्ण कामों में से एक है जो एक निवेशक कर सकता है। मतलब मुख्य सबक साफ है, फंड चुनते समय पिछले, खासकर थोड़े समय के प्रदर्शन पर बहुत ज्यादा निर्भर नहीं रहना चाहिए। ये मीन पर वापसी एक वास्तविक ताकत है।
ये जानकारी तो निश्चित रूप से निवेशकों को अपने फंड चुनने के तरीकों पर, अपने मानदंडों पर दोबारा सोचने पर मजबूर करती है। सिर्फ स्टार रेटिंग या पिछले साल के रिटर्न के पीछे भागना शायद सही रास्ता नहीं है।
बिल्कुल, और जाते जाते सोचने के लिए एक और पेच है इसमें।
अच्छा, क्या?
चलिए मान लेते हैं कि कोई फंड मैनेजर सच में बहुत कुशल है भी।
ठीक है, मान लिया।
तब भी क्या गारंटी है कि पहला, वो मैनेजर, उसकी टीम और उसकी निवेश रणनीति हमेशा वही रहेगी, बदलेगी नहीं?
वाह, ये तो मुश्किल है।
दूसरा, जैसे जैसे फंड का आकार बढ़ेगा, मतलब उसमें और पैसा आएगा, क्या वो उसी कुशलता से प्रदर्शन दोहरा पाएगा? बड़े फंड को मैनेज करना अलग होता है।
सही बात है। एसेट साइज बढ़ने पर प्रदर्शन बनाए रखना मुश्किल हो सकता है।
और तीसरा, क्या शेयर बाजार हमेशा उसी तरह के स्टॉक्स का साथ देगा जिनमें वो मैनेजर माहिर है? बाजार का मूड भी तो बदलता रहता है ना।
हाँ, बाजार की पसंद भी बदलती रहती है। ये तो वाकई बहुत महत्वपूर्ण सवाल है सोचने के लिए, जो हमें याद दिलाते हैं कि निवेश में कुछ भी निश्चित नहीं होता।
Welcome back to the deep dive. We've got quite a bit of material today looking into a really fundamental question. does getting professional financial advice actually help you pick winning stock funds?
Right. We've sort of touched on this before, establishing that, doing it yourself, DIY fund selection, is extremely difficult. So today, the mission is really to look at the evidence on professional performance.
Okay. But before we get straight into the performance figures, it's probably fair to acknowledge the broader value proposition, right?
Absolutely. Financial advisors, whether they're brokers or fee-only planners, they do a lot more than just pick investments.
Yeah, things like asset allocation, sorting out tax stuff, planning for big goals like college or buying a home.
And maybe most importantly, that behavioral coaching bit, helping investors avoid, well, let's call them dumb mistakes.
Like chasing last year's hot fund or trying to time the market dips and peaks.
Exactly. And those services definitely add value to the overall investment plan. There's no doubt about that.
Which probably explains why I think the stat is something like 70% of American families investing in mutual funds use an advisor or some intermediary.
That's the figure, yes. Around 55 million families rely on professional help. But, and this is the crucial part for today, when you isolate just the fund selection aspect, the results are pretty sobering.
How so?
Well, as a group, the advice advisors give on fund selection doesn't produce returns any better than the average mutual fund.
And the average fund itself already lags the market, doesn't it?
Right. It typically trails something like the S&P 500 index by about, say, 2.5 percentage points per year.
Okay, 2.5 points. That adds up. But is there more specific data on the advisor effect itself?
There is. A well-known Harvard Business School study looked at this period from 1996 to 2002.
And what did they find?
They found that funds sold through advisors, what they call broker channel funds, cost investors around $9 billion per year.
$9 billion a year, just from underperformance.
Yes, compared to funds that investors bought directly, without an advisor involved in the selection. The performance gap was significant.
How big are we talking? Give us the numbers.
Okay, so the weighted average return for investors using advisors for fund selection was just 2.9% per year during that period.
2.9%. Wow. And for direct investors?
They averaged 6.6% per year.
So more than double the return. Why such a huge difference?
The study pointed to a couple things.
Yeah.
Advisors chasing recent hot trends, performance chasing, and clients paying higher upfront fees or loads, especially with broker-sold funds.
Ah, the sales incentive problem again, that conflict of interest.
Precisely, which really highlights the importance, if you do use an advisor, of making sure they are genuinely fee-only. They get paid by you for advice, not by commissions for selling specific products.
Because when selling is involved, things can go wrong.
Dramatically wrong sometimes.
Yeah.
Look at the Merrill Lynch example from the sources. Back in March 2000, right at the peak of the dot-com bubble.
Oh, I remember that time.
Merrill Lynch launched these new economy funds, raised about $2 billion. One was called Internet Strategies.
Let me guess, it didn't end well.
It was catastrophic.
Yeah.
The Internet Strategies Fund lost 86% of its value before they finally just merged it away.
86% loss. Ouch. That's a stark example of, well, advice perhaps driven more by sales targets and market mania than client best interest.
Exactly. But, okay, let's broaden out again. We're not saying every advisor is bad at selection, but the average outcome isn't great, especially long-term versus just indexing.
Right, like that New York Times contest you mentioned from back in '93.
Yeah, they got 5 respected non-broker advisors to manage portfolios against a simple Vanguard S&P 500 index fund.
And the result?
By mid-2000, so about 7 years in, the index fund's profit was $138,750. The average advisor portfolio profit was only $88,500, about 40% less.
Even with respected non-broker advisors.
Even then. And the really long-term data is even more compelling. Mark Holbert tracked advisor recommendations over 26 years.
Okay, 26 years. What happened there?
A $100,000 investment just left in the S&P 500 index would have grown to nearly $2.5 million.
Wow. And the advisors' portfolios?
Following the consensus of tracked advisors, that same $100,000 grew to only about $1.4 million.
So over $1 million less over the long haul.
Yep. The conclusion from the sources seems pretty clear. Relying on advisors as a group to pick winning funds just doesn't really add value compared to indexing.
So the actionable takeaway then, if someone decides they still want an advisor, maybe for that behavioral coaching, the peace of mind, what are the absolute must-haves?
Number 1, they absolutely must be fee-only. No commissions.
Got it.
Number 2, the fee needs to be reasonable. The sources suggest not more than 1% of assets under management, maybe even lower for larger accounts.
Okay, fee only, reasonable fee. What else?
And critically, number 3, The advisor should be using low-cost index funds or passive funds wherever possible. The evidence just doesn't support paying extra for active managers who, overwhelmingly, fail to beat their benchmarks over time after fees.
Makes sense. So let's leave a listener with a final thought to chew on.
Well, consider this. The data strongly suggests you can outperform something like 80% of all investors, including many professionals over decades, simply by putting your money in a broad market index fund and basically doing nothing, just holding on.
So the question becomes,
Is the value you get from an advisor's other services, the planning, the hand-holding, preventing panic selling, is that value worth the fee you'll pay, which inevitably comes out of those potential index fund returns? It's a trade-off everyone needs to weigh for themselves.
okay, so let's jump right in. We're doing a deep dive today, looking at mutual fund success, but maybe controversially, we're going to ignore past performance.
That's right. Everyone seems to chase last year's winners, but the data, well, it points somewhere else entirely.
Somewhere more fundamental.
Exactly. It's really about the triumph of simple arithmetic. Past performance, it comes and goes, but costs stick around. They go on forever.
Okay, that makes intuitive sense. Costs are forever. If that's the key idea, the single factor, what costs are we talking about? Is it just the management fee?
Well, that's part of it. But our sources highlight three main types that persistently eat away at your returns.
3 types, okay.
Yeah. First, there's the obvious one,
Mm-hmm.
the fund's official expense ratio. Think of like the sticker price.
Right.
Second, you've got sales charges, those loads, because honestly, a load fund almost never becomes a no-load fund down the line.
Stays a load fund, got it. And the third?
The third one is often overlooked. It's the portfolio turnover costs.
Turnover. That sounds a bit technical, but crucial if it's hidden. How do we figure that cost out?
Right. So turnover basically means transactions, buying, selling. And every time a fund manager does that, it costs money. Commissions, market impact, things like that.
Okay.
Our sources estimate it's roughly 0.5% for each trade, buying or selling.
0.5% each way.
Exactly. So the rule of thumb, kind of a quick calculation, is that your turnover costs are essentially 1% of whatever the fund's annual turnover rate is, because you buy and then eventually you sell.
Wow, okay. So when you put the reported expense ratio together with that estimated turnover cost, the numbers must get pretty big.
Oh, it's sheer dynamite, as one source put it. If you sort funds into quartiles, cheapest 25% to most expensive 25%.
Uh-huh.
For the decade 1995 to 2005, the all-in annual costs for the cheapest funds were, well, manageable, around 0.9% of assets.
Okay, under 1%.
But, and this is the kicker, for the highest cost quartile, those costs exploded to 3.0% every single year.
3%, that's huge. It's devastating. And here's the really crucial part. The managers themselves, before costs, were getting basically the same results.
Wait, really?
Yeah. Over that whole decade, the gross returns, before any costs, were almost identical. They only ranged from about 12.0% to 12.8% across all the groups.
So the expensive fund managers weren't actually better stock pickers?
Not discernibly, no, but the high costs just ate up the returns.
What did that mean for the actual net returns?
Well, the low-cost funds, they delivered a solid 11.7% net return per year.
Pretty good.
The high-cost funds, though, basically stalled out. They only managed a 9.0% net return.
Okay, so that gap, let's see, 2.7 percentage points difference.
Right, and the cost difference itself was 2.1 percentage points. That cost gap accounts for almost the entire performance difference.
That 2.7 points a year, that really adds up over time.
It's absolutely the difference between comfort and worry in retirement for many people.
Okay, so they made less money. Did the expensive funds at least offer a smoother ride? Less risk? You'd think so, maybe. But no, the sources show the opposite, actually. There's a hidden risk factor.
Hidden risk. So when we say risk-adjusted, what are we adjusting for here?
We're adjusting for volatility, how much the fund's value jumped around. And what's just staggering is that the highest expense, highest turnover funds took on fully 34% more risk than the low-cost ones.
34% more risk for a worse return.
That's the punchline. When you adjust for that extra volatility, the low-cost funds actually performed 47% better.
47% better on a risk-adjusted basis. Wow.
And compound that over the decade, low-cost funds gave you a 207% cumulative gain. High cost, just 118%.
So nearly double the profit, almost entirely because of costs. That's incredible.
It really is. And that leads us naturally to the group with the lowest costs of all Index funds.
Right, because they don't trade much.
Exactly. Their costs average just 0.2% a year. Tiny. And virtually zero turnover costs because they just, track the market.
And the results.
The index fund's compound profit, risk-adjusted, was 194%.
Better than the average managed fund.
Easily. The average managed fund came in at 154%, and the index fund did it with less risk, less volatility.
So this leads to that paradoxical conclusion you mentioned?
Yeah, the key takeaway from the research is basically this. Gunning for average is your best shot at finishing above average.
By choosing low-cost index funds.
The record is just so clear. The more the managers and the brokers take out in costs and fees,
the less you, the investor, actually make.
Precisely.
So, boiling it all down for you listening, if there's only one single factor you could use to pick funds likely to do well and avoid the ones likely to lag,
forget the past performance hype.
it has to be costs. Fund costs are key.
Which leaves us with a final thought for you to chew on. The highest cost funds didn't just give you lower returns.
They also made you take on significantly more risk, about a third more risk, to get those worse results.
So think about that combination. Less gain, more bumps in the road. What does that truly cost you over an entire lifetime of investing? Especially when something like retirement is riding on it.
Okay, so today we're doing a deep dive into something the source material calls the majesty of simplicity when it comes to investing.
Yeah, it's a great phrase.
Our mission is really to get grips with the absolutely critical role of index funds and why focusing on what sounds kind of boring, the relentless rules of humble arithmetic, is actually the smartest way to go.
It really is. And the core idea starts with cost. It's just overwhelmingly logical, to pick the funds with the very lowest cost.
Specifically index funds, right? The ones designed to just own the whole stock market.
Exactly those. We're talking funds where the total costs, the all-in expenses, can be as low as, say, 10 basis points.
Wow, 0.10% a year. And that's what, compared to active funds?
It can be up to 80% lower than even the cheaper active funds. That gap, year after year, it really adds up. It's massive over the long term.
The evidence seems pretty overwhelming.
Oh, it is. The stats back it up completely. If you just look historically, the S&P 500 index fund versus your average active equity fund, well, the index fund just wins over decades. It's pretty undeniable.
So the source mentions something called a Monte Carlo simulation to really hammer this home. Tell us about that.
Right, yeah. It's a fairly complex statistical exercise. But the goal is simple. Figure out the real probability of success.
How does it do that?
It basically takes, like, a century of monthly stock market data and runs simulations thousands and thousands of times. This helps project the odds of a passively managed fund, like an index fund, beating an actively managed one over different time periods.
Okay, so what are the odds? Assuming, say, passive costs are low, maybe 0.25%, and active costs are higher, like 2%.
Well, the projections for active managers aren't great. Even over just 1 year, only about 29% are expected to actually beat the index.
Huh, okay. Less than a third. But what about longer term? That's what really matters for investing.
And that's where it gets really, really sobering. Over 10 years, that 29% drops to just 9%.
Only 9% winning after a decade.
Yeah. And push it out to 25 years. The projected success rate for active managers falls to only 5%.
5%, wow.
And if you go really long term, say 50 years, it's down to just 2%. The math basically says your odds of kicking one of those very few long-term winners beforehand are, frankly, terrible.
But hang on, if 5% do win over 25 years, doesn't that mean it is possible? Why dismiss that?
It's a fair question. But think about it, that 5% is like finding a needle in a giant haystack. You don't know which 5% it will be before the 25 years start.
Right, you can only see it in hindsight.
Exactly. You'd have to potentially endure decades of underperformance with a 95% chance of ultimately failing just to maybe find one of those winners. It's just not a practical strategy for most people.
Which brings us back to costs, even within index funds themselves. The source warns they aren't all created equal.
That's a really critical point. You might think, okay, an S&P 500 index fund is an S&P 500 index fund. The stocks they hold are virtually identical.
Makes sense.
But their costs can be wildly different. And that difference in cost is actually where your success or failure can be decided.
How big can that gap be?
Well, it can be quite large. Among funds tracking the same S&P 500 index, offered by different companies, the annual cost difference can be more than 1.2 percentage points.
1.2% difference for holding the exact same stocks. That's huge.
It is. And there's a great historical example in the source. Take $10,000 back in 1984.
Okay.
You put it in the low-cost Vanguard 500 index fund, no sales charge. very low expense ratio. Or you put it in the Wells Fargo Equity Index Fund at the time.
What was different about that one?
It had a big 5.5% initial sales charge right off the top and a higher ongoing expense ratio.
Ouch. So what was the result over time?
It's pretty dramatic. That $10,000 in the low-cost Vanguard fund grew to a profit of about $122,700.
Nice return.
But the same $10,000 in the high-cost Wells Fargo fund, only about $99,100 in profit.
So what's that, like a $23,000 difference? Just because of fees and sales charges?
Entirely. Same underlying investment, vastly different outcome purely because of costs.
So the lesson for you, the listener, is crystal clear. Stick to index funds with absolutely no sales loads and the very lowest operating costs you can find.
Make the fund your cash cow, not the manager's. That's the goal.
And this isn't just for large U.S. stocks, right? Indexing works across the board.
Generally, yes. The source mentions, for example, the S&P Mid-Cap 400 Index outperforming something like 84% of active mid-cap funds over 5 years. So the principle holds.
Okay, so the math works, the costs are key.
Yep.
But there's another hurdle, isn't there? Us, our emotions.
Ah, yes, the human element. This is often where even a winning strategy like indexing can go wrong for the individual investor.
How so?
People chase performance. They see something doing really well, pile in near the top, then panic and sell when it drops. Terrible timing. Yeah. The source calls it a loser's game.
Is there an example of this?
There's a striking one with Vanguard's own growth and value index funds between the early 90s and mid-2000s. The growth index fund itself did well. It returned about 9.1% per year.
That sounds pretty good.
It was. But look at the investors in that fund. They poured money in during the tech bubble when it was sky high, and then pulled money out after it crashed. So the average dollar-weighted return for the actual investors in that fund, it was a pathetic 0.9% per year.
0.9%. When the fund itself made over 9, that's not, wow.
It shows the devastating impact of bad timing driven by emotion. The money flowed in and out at precisely the wrong times.
So the takeaway message really comes together then.
Absolutely. You need to diversify as much as possible, which index funds do. You need to be relentless about minimizing costs. And, crucially, you have to manage your own emotions.
Stick with the plan. Maybe just stick with a simple, classic, all-stock market index fund.
That's often the best approach. Keep it simple.
This reminds me of that Charlie Munger quote about the croupier's costs in active management.
Yeah, the house always takes its cut. He estimated those costs, advice, fees, trading, could eat up maybe 3% of your net worth every single year with active strategies.
And if those costs exist,
then mathematically, Munger points out, exactly half of all investors must get a result below the median return after those costs are taken out.
and the median itself might not even be that great. He called it potentially unexciting and lousy.
Precisely. So why pay the croupier? Why add all that complexity and cost when simple low-cost indexing is pretty much guaranteed by arithmetic to give you a better shot at capturing the market's actual return over the long haul?
A powerful thought to leave everyone with. Why indeed?
Welcome to the deep dive. So today we're stepping away from the stock market's wild ride, and we're looking instead at fixed income securities. You know, bond funds, money market funds.
Right, a totally different beast in many ways.
Exactly. And our mission really is to see if those relentless rules of arithmetic, the power of low cost, hit even harder here than with stocks.
Yeah, it's fascinating when you look at the sources. With stocks, you've got so many things going on, right? Company performance, economy, sentiment.
Endless variables.
But in fixed income, it seems like pretty much, almost 100% of the long-term return is already baked in by one single thing.
Okay, one single factor. Let's
Yeah.
dig into that. What is it? And why does that immediately put active managers, well, kind of behind the eight ball?
It's just the prevailing interest income. Simple as that. And that's set by, huge global economic forces, the Fed, that kind of thing, not the fund manager.
So they can't just call up the Fed and ask for higher rates.
No, they're purely rate takers. And here's the kicker. Because the potential returns in bonds are generally lower than stocks to begin with.
Right.
Even like a 1% fee takes a huge bite out of your total return. It makes keeping costs low absolutely essential, not just, nice to have.
Okay, so if they can't control the main driver, the rates, how do active managers even try to add value? What's left for them to do to justify those fees?
Well, they basically have two main levers, and honestly, both involve cranking up the risk.
Okay.
They can either try to make bets on where interest rates are going, timing the market, which is notoriously difficult,
Mhm.
or they increase the riskiness of the bonds in the portfolio.
How do they do that?
Usually it means either buying longer-term bonds, extending maturity, which makes the fund way more sensitive to rate swings.
More volatile, yeah.
Exactly. Or they lower the credit quality, moving away from safe government stuff towards, well, maybe riskier corporate bonds.
Sometimes even into what people call junk bonds, right?
Precisely. And that brings up a really crucial point about safety. I mean, a stock can go down, but it can't default like a bond can.
Good point. A bond is debt. Someone owes you money.
Right. And that debt might not get paid back. It really hammers home that old quote from Louis Brandeis. Arithmetic is the first of the sciences and the mother of safety. Costs become the biggest risk when your upside is limited.
Okay, so given those limits, let's see the arithmetic in action. We've got some pretty stark numbers for intermediate-term taxable bonds over 10 years. This seems like a category where indexing really shines.
Oh, it's night and day. We found a low-cost index fund charging just 0.18%.
Tiny.
Yeah, tiny. It returns 6.79% per year on average. Now, compare that to the average actively managed fund in the same category. Its expense ratio, 1.00%.
Oof, 5 times higher.
Right. And its return, only 5.50% a year.
Wow. So that difference, roughly 0.8% in fees, costs investors about 1.3% in annual return.
Yeah.
That adds up massively.
It really does. Think about it this way. If you put $10,000 in, the index fund grew to almost $19,300. The average active fund, just barely over $17,000. That's what, like a $2,200 difference on just 10 grand, mostly just because of costs.
That's huge. And it really drives home the advice to just always steer clear of bond funds with sales loads, right?
Absolutely. A typical 5% load that wipes out your entire first year's income, maybe more, just avoid them. And, the sources show this pattern holds everywhere. Long-term munis, short-term treasuries, low-cost wins, period.
Okay, so if active managers struggle, even where there's some complexity, what about the absolute simplest, safest end of the fixed income pool? Money market funds.
Right. This is kind of the ultimate commodity.
Yeah.
These funds have to hold super high quality debt, and the maturities are incredibly short. Think 40, maybe 60 days on average.
So the underlying stuff is basically all the same.
Pretty much identical. Their gross yields before fees are going to be virtually the same across the board. So performance comes down almost entirely to one thing.
Costs.
Costs. The link between low cost and high return here is, it's almost perfect.
Which makes the cost details we found just kind of unbelievable. How can something designed purely for safety have high fees?
Well, they do, and
Yeah.
it's shocking. The funds in the highest cost group, the top quartile for fees, had an average expense ratio of, get this, 1.39% per year.
1.4%
Ooh.
on a money market fund.
Insane, right.
Yeah.
So after fees, they only gave investors a net return of 2.71%. Meanwhile, a simple index proxy tracking the same market delivered 3.87%.
So those high fees didn't just trim the return, they basically ate most of it.
They devoured it. It completely destroyed any competitive return the fund might have had. It's just
Yeah. So wrapping this up, what's a big takeaway for you, the investor looking at bonds or money markets?
It really boils down to keeping it simple. Stick to the basics. Broad diversification, low costs, definitely no sales loads, minimal trading or turnover, and just holding for the long term.
That guarantees your fair share.
Exactly. Because the evidence is overwhelming that active managers in the bond world just can't consistently overcome their higher costs. The math is just too powerful.
And here's a final thought to chew on. One study looking back from 1988 to 1998 found that U.S. bond index funds beat 85% of their active rivals over that decade.
85%.
Yeah. It just shows how high the hurdle is. An active manager has to add a lot of value just to get back to even after their fees. Something to really think about next time you see a bond fund charging 1% or more.
Okay, so let's dive into this world of index funds.
Right.
Specifically, these newer strategies. They promise the success of indexing, but, they also claim they can beat the market.
Yeah, that's the hook, isn't it? Market-beating returns from an index.
Exactly. So the big question we're tackling is, can a structured index, like one that's deliberately designed, actually outperform consistently?
It's a great question. And to really get at it, you kind of have to start with the original, the classic index fund. Why did it work so well?
Good point. It goes back to, 1975?
Yep, around then. And its success has been, phenomenal. You mentioned the growth, tiny start.
Yeah.
Then hundreds of billions.
So why? What was the magic?
It's almost anti-magic. It's just simple arithmetic. Think about it.
Hmm.
All investors together own the entire market.
Right. So collectively, they have to earn the market's return. Before any costs, anyway.
Precisely. Before costs, and that's the key. The classic index fund's genius wasn't picking winners. It was, frankly, being cheap.
Thrift, not brilliance.
Exactly. Minimize those costs, trading costs, management fees, and you mathematically guarantee that your investors, as a group, will get a higher net return than the average of other investors who are paying more.
So it's a guaranteed win against the average active manager over time just by cutting costs.
Over the long haul, yes. It's built on that cost advantage.
Okay, but if the winning strategy is just being the cheapest, that puts huge pressure on the fund managers themselves, right? Low fees mean lower profits for them.
Absolutely. Fierce price wars, profits get squeezed, and that creates an opening or maybe a temptation for someone to say, hey, I've got a better index and it's worth paying a bit more for.
So that's where these new strategies come in. They're not really passive in the old sense.
Not at all. They're built on newly constructed indexes, often claiming some kind of systematic edge, some new methodology, and yes, they charge higher fees for that potential extra return.
Let's get a bit technical then. The classic index, like an S&P 500 tracker, is cap-weighted.
Correct. Capitalization weighted. Bigger company, bigger slice of the index. You're basically holding the market as it is.
So how do these new ones differ? What are they weighting by?
That's the crucial difference. They often use what they call fundamental factors, things like a company's revenues or its cash flow, maybe book value, dividends.
Not just its stock market size.
Right. They argue the cap-weighted index holds overpriced and underpriced stocks. And their claim is, essentially, our factor-based approach knows which is which, or at least tilts the odds in your favor.
They sound like active managers, but calling it indexing.
You could definitely see it that way. They're active strategists creating rules-based portfolios, often calling it smart beta or, a new paradigm.
Okay, but hang on. They often show these backtests, right? Studies going back decades showing their factor, like value or whatever, did outperform the standard index, maybe by 1% or 2% a year.
They do, and that's where you have to be careful about data mining.
Data mining, meaning they looked until they found something that worked historically?
Pretty much. I mean, nobody's going to launch a new fund based on a factor that lost money in the backtest, right? You find what worked in the past.
Okay.
But even if you accept the historical outperformance, the real challenge is the cost now, today.
Right. You mentioned the higher fees. Let's break that down because that seems critical for anyone listening.
It really is. A classic S&P 500 index fund might cost you, 0.03%, maybe even less. These fundamentally weighted funds, they can run from, say, 0.28% easily, up to, I've seen 1.5%, even close to 1.9%.
Wow, that's a huge difference. That eats up that potential 1-2% edge pretty fast.
It certainly can. And it's not just the expense ratio, because they're tracking factors, not just market cap. They often have to trade more to rebalance.
Higher turnover.
Exactly, which means more brokerage commissions paid by the fund and potentially more taxable gains distributed to you, the investor. So costs pile up.
Which brings us back to that core idea. If these factors, like value or low volatility, really were systematically underpriced in the past, wouldn't smart investors just pile in now, bidding up the prices of those stocks until that advantage disappears?
That's the million-dollar question. It's the efficiency argument. Once an anomaly or a factor is widely known, published and packaged into products,
It gets arbitraged away.
the market tends to adjust. If everyone knows value stocks are supposedly cheap, they won't stay cheap for long. What worked historically might not work going forward, precisely because it's now a known strategy.
This whole thing really starts to sound like themes we've seen before in finance. History repeating itself.
You definitely get that feeling. Think about the new eras of the past. The go-go stocks in the 60s.
The Nifty 50 in the 70s. Everyone knew those were can't-miss stocks.
Right, or tech stocks in the late 90s. They were all based on certain factors, growth, quality, whatever, that seemed unbeatable at the time. And they all eventually, they reverted to the mean. Sometimes painfully.
So we need that longer perspective. Common sense, maybe.
A healthy dose of skepticism, definitely. Karl von Clausewitz, the military strategist, had a great line. The greatest enemy of a good plan is the dream of a perfect plan.
Meaning?
Meaning, the classic, boring, low-cost index fund is a good plan. It works. It guarantees you your fair share of market returns. Chasing that perfect, market-beating strategy often leads you astray.
It practically guarantees you'll beat most other investors simply because you're keeping costs down.
Over the long run, yes.
Hmm.
You're likely to outperform 90% or more of active investors net of costs.
And didn't William Sharpe, the Nobel laureate, weigh in on this too?
He did. He basically said, look, these new paradigms, they come and go. Betting against the market, especially when you're paying extra for the privilege.
Is hazardous.
That's the word he used, hazardous. Because ultimately, the core logic holds. Minimize costs, diversify broadly. That's the most reliable path.
So the simple, maybe slightly boring approach is still the champion.
The data strongly suggests it is. Low cost wins the long game. Okay, let's unpack this. We're doing a deep dive today on the exchange-traded fund, the ETF. Our sources, well, they kind of paint the ETF as maybe a bit of a wolf in sheep's clothing, really challenging the original idea of index funds from way back.
That's a good way to put it. Yeah, our goal here is to compare that original index fund model, patient long-term focus, with what the source calls the index fund nouveau, the ETF. Exhibit 15.1 in the reading really highlights how different the core visions are.
Right. The original was all about patience. But how exactly does the ETF structure, encourage the opposite? The classic model was simple. Longest horizon, broadest diversification, lowest cost.
Exactly. And the ETF, well, in practice, it kind of flips those principles. They're built for short-term trading, even intraday trading. Plus, they often zero in on really specific narrow sectors. And the cost thing, it's tricky.
Tricky how? They always advertise low fees.
They do. The headline expense ratio is low, but that doesn't include brokerage commissions every time you trade, or the tax impact from all that buying and selling, so that low cost can disappear pretty fast. Classic funds aim to give you the market's return, fair and square. With ETFs, if you're trading a lot, the source says investors often have absolutely no idea what return they'll actually end up with.
But wait, the first ETF, the SPDR, the Spider back in '92, wasn't that actually a pretty brilliant idea for people who did want to hold long-term? Is the issue the product itself or how it's used?
That's the core of it. The concept was brilliant, especially for long-term folks, but the source points out that most people jumping into Spiders early on weren't buy and hold investors. They were active traders, hedgers, using it very differently. And this led to this huge, almost like a stampede, as the source calls it. Entrepreneurs saw an opportunity, complexity grew, and boom. By the time our source was written, ETFs were already at $410 billion. That's like 41% of all index assets back then. Huge growth.
Wow. And you really see that stampede you mentioned in the turnover rates. This isn't patient investing at all. Spider's turning over at, what, 3,600% a year? And the NASDAQ Qcoma is even higher, 6,000%. What does that even mean? A 6,000% turnover.
It means basically the average share is changing hands 60 times in 1 year. 60 times.
60?
Yeah. It feels less like investing and more like, I don't know, day trading fuel. And it's not just the big ones. Even those specialized sector ETFs, owning just semiconductor stocks or just the South Korean market, that kind of thing, they averaged 200% turnover. And some, like the SPDR energy shares mentioned, hit an unbelievable 8,500% turnover rate in a year.
Okay, so if people are trading that much, that whole low-cost advantage of the ETF must just, well, evaporate, right? What happens when you add in all the commissions and other fees?
It explodes, essentially, especially for the specialized ETFs. You've got brokerage costs every time you trade. And if you hold them in certain advisory or rep accounts, you could be looking at annual fees of maybe 1% to 3%.
1 to 3% compared to what for a classic index fund?
Well, the best classic broad market index funds back then were costing maybe 10 or 20 basis points, so 0.1% or 0.2%.
Okay, pennies on the dollar compared to potentially 3%.
Exactly. A massive difference in the actual all-in cost for the investor.
So investors get hit twice, the double whammy, as the source puts it. They're trying to time the market, chasing hot sectors, which often backfires because it's driven by emotion.
Counterproductive timing.
And they're paying through the nose in costs while they do it.
Precisely. And there's data to back this up. It's pretty sobering, actually. Researchers looked at the top 20 performing ETFs from 2003 to 2006. Great fund returns on paper. But the average shareholder in those funds, they actually underperformed the fund's own reported return by 5 percentage points per year.
5% a year just lost to timing and costs.
Lost entirely to bad timing and high costs. It's a huge wealth drain directly linked to how these products are often used.
It really brings that analogy from the reading to mind, the Purdy shotgun.
Right.
Great for big game hunting, but also excellent for suicide. A powerful tool, but dangerous if you don't know exactly how to handle it.
And it wasn't just academics noticing. Industry figures were sounding alarms, too. Don Phillips from Morningstar warned that these specialized tools, while maybe useful for pros, really increase the risk for everyday, less sophisticated investors.
Makes sense.
And Jim Whelan from the Journal of Indexes, he basically said this whole trend towards enhanced indexing and complex ETFs, it seemed more about managers chasing fees than actually helping the investor's bottom line.
So wrapping this up, what's the takeaway for you, the listener? When you look at ETFs, you really have to ask, are they genuinely low cost once you factor in commissions and potential frequent trading? Is that constant buying and selling likely to beat a simple buy and hold strategy over time?
Right. The source leaves us with that big question. Is this index fund nouveau really an investor's dream, or is it perhaps more of an entrepreneur's dream come true?
Definitely something to think about. We'll leave it there for this deep dive. Okay, let's dive in. We're talking Benjamin Graham today.
Yeah.
You know, the intelligent investor, the absolute bedrock of value investing, finding those bargain stocks.
The father of it, really. Deep fundamental analysis.
Exactly. But here's the paradox we want to explore. Graham, he was incredibly pragmatic. And hidden in his work is this really strong case for index funds.
Right. Even though they weren't really a thing when he first wrote The Intelligent Investor.
Yeah, that's the fascinating part.
So our mission here is to unpack Graham's own principles, show how they logically lead straight to the idea of indexing, especially for what he called the defensive investor.
He drew a really sharp line there, didn't he, between the active, enterprising investor and the defensive one.
A very firm line. And he was clear that most people fall into that defensive category.
Why did he think that? What was his reasoning?
Well, his rationale was pretty blunt. He basically said most everyday investors lack the time or the determination or the mental equipment needed.
To treat investing like a serious business.
Right.
A quasi-business, I think he called it.
Precisely. If you can't commit that level of effort and skill, trying to be an active stock picker is, well, it's probably setting yourself up for failure.
So what was his advice then for this majority, for the defensive investor?
It was pretty straightforward. Be satisfied with a reasonably good return. Get that from a simple defensive portfolio. Don't chase spectacular results you likely won't achieve.
Okay, so diversification, holding for the long term.
Absolutely. He famously said, the real money will be made not out of buying and selling, but of owning and holding securities. Minimize mistakes, don't maximize brilliance. For him, avoiding failure was key for most people.
It's kind of amazing, given his own expertise and analysis, how skeptical he became about professional money managers actually delivering.
Oh, deeply skeptical. And he had data early on. He looked at mutual funds between 1937 and 1947.
Okay, what did he find?
Well, the S&P 500 index returned about 57% over that decade. The average actively managed fund, only 54%.
So basically, they didn't beat the market even back then when costs were lower.
Exactly. His conclusion was that the funds were just barely able to, quote, absorb the expense burden. The costs basically wiped out any potential skill.
And that skepticism, it only grew stronger over time, didn't it?
It really did. By 1976, his language got, frankly, quite harsh. He called Wall Street a Falstaffian joke.
Wow. A joke.
Yeah, and a huge laundry. He saw it as institutions just churning huge blocks of stock back and forth, not really doing much productive investing.
So just generating fees and activity?
Pretty much. And think about today, the costs are way higher. Portfolio turnover often exceeds 100% year. Graham would have been appalled. He'd call that rank speculation, not investing.
And 1976 is such a key year here. It's when he gave that scathing assessment, but it's also the year the very first index mutual fund launched.
The timing is incredible. And in an interview that same year, he basically settled the whole active versus passive debate from his perspective.
Okay, what did he say? This feels like the crucial moment.
He was asked directly, can the average institutional manager realistically expect to beat the S&P 500 index over time?
And his answer?
Just one word. No.
Blunt.
Very. He went on to call the expectation that they would beat the market, quote, a logical contradiction.
A logical contradiction? How so?
Think about it. The market is the average of all investors. For everyone collectively, to beat the average is mathematically impossible, especially after you subtract all the costs, The research, the trading fees, the management expenses.
Right, someone has to underperform for someone else to outperform, and the costs drag everyone down relative to the market itself.
Exactly. He reasoned that security analysis, his own field, had become less rewarding. Why? Because there was just an enormous amount of research now being carried on.
So too many smart people looking for the same thing.
Kind of. It meant that even sophisticated techniques were unlikely to find enough truly superior selections to justify their cost. The edge was gone, or at least the cost of finding it was too high for most.
So bringing it all together, what was his final word for that defensive investor? For most of us.
His conclusion was unavoidable, really. He said he saw no reason why investors should be content with results inferior to those of an indexed fund.
Wow. Coming from Benjamin Graham, that's huge.
It is. And it connects to his broader philosophy. To achieve satisfactory investment results is easier than most people realize. You don't need complexity.
And just to put the final nail in it, his most famous student, Warren Buffett, completely backs this up, right?
Unequivocally, Buffett has said many times that Graham himself took this position many years ago. Buffett constantly argues the index fund is the most sensible equity investment for the great majority of investors.
So the endorsement is total, from the master and the star pupil.
Which leaves us with a final thought for you, the listener. If the goal, as Graham put it, is simply satisfactory investment results,
And he showed that an index fund pretty much guarantees you your fair share of whatever the market delivers.
then the question you might want to mull over is this. What unnecessary risks, or maybe more importantly, what unnecessary costs are you still putting in your own portfolio, perhaps chasing something that even the father of value investing suggested you probably shouldn't?
Welcome. Today we're diving deep into something pretty fundamental in investing. It's that big debate. Active fund managers versus, well, just buying the index.
Right, and we're not going by gut feeling here. We're digging into the sources, focusing on what they call the relentless rules of humble arithmetic, basically the simple math behind it all.
Yeah, the numbers don't lie, supposedly. And what's striking is who's saying this.
It really is. You've got Nobel winners like Kahneman, Samuelson, then investors like Buffett, Munger, academics, practitioners. They're, mostly landing on the same page.
So what's the core idea? The sources seem almost, well, blunt about it.
They kind of are. The main thesis is that, look, the classic broad market index fund, that's pretty much the only fund you can confidently just buy and hold forever.
Okay, forever's a long time. Why such strong confidence? It's not about predicting markets, right?
No, not at all. It's based on just two really simple things, two pillars, the sources call them.
Pillars, okay. What's the first one?
Broad diversification, like the broadest possible. You
Right.
buy the whole market, essentially.
So you're not betting on specific stocks or a manager's genius.
Exactly. You get rid of individual stock risk, style risk, manager risk, all that stuff. You're basically left with just the market's own ups and downs. It's the ultimate risk reduction, in a way.
Minimizing the things you can control, or rather, the risks you can avoid. Makes sense. What's pillar number 2?
Costs, rock bottom costs, and minimal taxes, too.
Ah, the fees. Always the fees.
Right. An index fund just tracks the market. It doesn't need huge research teams, lots of trading. So the overhead is tiny,
Meaning you keep almost all the market's return.
pretty much.
Hmm.
The gross return of the market minus just a tiny, tiny slice for costs. It's efficient.
Okay, so diversification and low cost for indexing. Let's flip it then. What about active management? The math there sounds less friendly?
Well, yeah, here's the thing. All actively managed funds together, before costs, they have to equal the market average return. It's just arithmetic.
Right, because they are the market collectively.
Exactly. But then the costs kick in. And that's the first big gap, what
Yeah.
the sources call the all-in costs.
All in, so not just the management fee.
No. It's the fee plus high turnover, account, lots of buying and selling, which leads to transaction costs, broker fees, spreads.
And that adds up.
Oh, yeah. The sources estimate it creates like a 2.5 percentage point drag per year on average.
2.5%? Wow.
Yeah.
That's huge year after year. Does that mostly go to the managers and brokers?
Pretty much. It's a massive headwind for the funds to overcome just to match the market, let alone beat it after costs. But wait, there's more.
Oh, great. What else?
It's us, the investors.
We mess it up even more. How?
Yeah, apparently we do. The data suggests investors lose another 3 percentage points a year, roughly.
3%. On top of the fund cost. How?
It's called the twin penalties. Market timing, trying to jump in and out, and fund selection, chasing hot funds, basically. Bad decisions driven by emotion.
So expenses and emotions. The 4 E's they mentioned.
Yeah.
No, wait, what were the 4?
Haha, close. Just 2 E's, actually. Expenses and emotions. Those are the big enemies, according to the sources.
Okay, expenses and emotions, got it. And the industry itself doesn't exactly help, does it? There's a critique in there about structure.
Right. The fact that managers control the funds, not the actual owners, the investors, their main drive often is just getting bigger, asset size.
Market share over everything.
Yeah, the great God market share, as one source puts it. Which means, aggressive marketing, pushing whatever's hot.
Like the old go-go funds or the Nifty 50 or maybe some complex ETFs today.
Exactly, chasing fads, which is rarely good for the long-term investor.
Okay, so stepping back from the costs and the bad behavior, what's the really simple core principle here, the foundation?
It goes back to Rule 1, essentially. Long-term, stock returns come from the businesses themselves. Meaning dividends plus earnings growth, that's the real return. The speculation, the trading back and forth, that tends to just wash out over time. You win by owning businesses, not by, timing stock trades.
Own the orchard, don't bet on the price of apples next week.
That's a good way to put it. And that clarity is why you see these, really smart people landing on indexing. David Swensen at Yale, he called the fund industry a colossal failure. Strong words. Said it was systematic exploitation because of fees.
Wow. And Kahneman, the psychology guy.
Daniel Kahneman, yeah. Nobel winner for showing how biased our thinking is. He says investor overconfidence leads to mistakes. And he just uses index funds, says, I don't try to be clever at all.
If the guy who wrote the book on cognitive bias isn't trying to be clever, maybe we shouldn't either.
It's pretty compelling. And then you have Buffett.
Buffett's always clear on this.
Always. Says the know-nothing investor, his words, can beat most pros just by using low-cost index funds. Calls them the best choice for most people wanting to own stocks.
So it really boils down to that simple math again.
Absolutely. The relentless rules of humble arithmetic.
Yeah.
It's just, what does the market give you minus what do the middlemen take away? Indexing minimizes that takeaway.
And the sources end with a bit of a warning shot for the active industry, don't they?
They do. A suggestion that, ignoring what's best for your clients forever, that's probably not a sustainable business model. That eventually the industry might be hoist on its own petard, undone by its own flaws.
So maybe the final thought for you listening is this. If the simplest path, the one based on just arithmetic, consistently outperforms complexity and supposed expertise, what does that say about where you're putting your own money? Something to think about.
Welcome to the deep dive. Today, we're digging into something called common sense investing. Our goal is really to unpack the logic behind keeping things simple, index funds, and this strict way of dividing up your money. Why is that seen as the best bet for most people?
Well, yeah, it's fascinating because the experts, they actually tend to agree on the core idea.
Yeah.
Which is that for the vast majority of American families, the best approach is owning an all-U.S. stock market index portfolio.
Yeah.
And an all-U.S. bond market index portfolio.
Right.
Now, look, it might not be the absolute best strategy ever invented, probably isn't, but the number of strategies that are worse, it's basically infinite.
That really sets a baseline, doesn't it? But it brings up a problem, a very human one. Because we know most people don't do this. They go for complexity, right? Expensive active funds, lots of trading.
Exactly. They're chasing excitement, maybe.
Yeah.
Or they just have too much confidence in their own ability to pick winners.
Yeah, overconfidence kills.
It really does.
Yeah.
And that's why you need discipline, like enforced discipline. Which brings us to this idea of the 2 accounts. It's a strict rule.
Okay, lay it out for us.
You have your main serious money account. That must hold at least 95% of your assets, minimum. Then you have the funny money account. And this is key. Not 1 penny more than 5% goes in there.
Okay, so 95% serious. And that serious part, the mandate is clear there too, right?
Oh, absolutely. That 95% serious pot. It should be at least half, maybe even up to 100% in just plain old classic index funds, low-cost index funds.
And the other 5%? The funny money.
That's your outlet. Sort of a psychological release valve, you could say.
Yeah.
It's acknowledging we're human. We like a bit of a gamble sometimes.
So you can gamble, just not with the important money.
Precisely. Use it for picking stocks if you want, or maybe even some active funds. But only if the managers, own their own firms, invest for the long haul, and even then, expect them to lose to the index fund probably 1 year out of 3. That's just the odds.
Got it. And even within that small 5% slice, there are things you should definitely avoid, right? A kind of don't touch list.
Yes, definitely. We strongly, strongly advise against commodity funds.
Why is that? They're popular sometimes.
Well, fundamentally, you're not owning a piece of a business, like with stocks. There are no earnings, no dividends. You're just betting on which way the price will go. You lose that core advantage of owning equities.
Makes sense. And hedge funds. Big no-no.
Absolutely.
Yeah.
Often they feel more like a compensation strategy for the managers than an investment strategy for you, given the huge fees.
Right, the 2 and 20 model. Or worse.
And if a single hedge fund is too expensive, imagine a fund of hedge funds. You're just stacking fees on top of fees. It's rarely justifiable.
Okay, so avoiding unnecessary costs is huge. Let's swing back to the 95% then, the serious money. Because if returns are tight, costs really, really matter. Are there any acceptable tweaks to that core portfolio? Like, what about investing outside the U.S.?
Yeah, that's a fair point. If you want broader global exposure, okay. But foreign stocks probably shouldn't be more than, say, 20% of your total stock portfolio. And ideally, you do that through a low-cost total international index fund. Keep it simple. Keep it cheap.
Okay.
But linking this back, the single biggest decision you make isn't which specific fund, it's your asset allocation.
The split between stocks and bonds.
Exactly. That's what drives your long-term return more than anything else.
So what's the simple rule there, the common sense rule?
The classic rule of thumb is to hold a percentage in bonds roughly equal to your age, or, maybe your age minus 10% if you want to be slightly more aggressive.
Age minus 10%. So like a 30-year-old would only have 20% in bonds. Feels a bit low, maybe, given how wild markets can get.
It does feel low to some, and that's where your personal comfort level has to come in, definitely. But the math supporting a conservative stance is pretty compelling, and it connects directly to the arithmetic of investing. This is critical.
The arithmetic, what do you mean?
Okay, look at the equity premium. That's the extra return you expect stocks to give you over safe bonds. Right now, it's maybe around 2%. Historically, it's been higher, but let's say 2%.
That seems really thin.
It is razor thin. And think about what that means. An actively managed stock fund, maybe it charges, 1.5%, 2% in total costs. That fee alone wipes out almost your entire expected extra return before you see a dime.
Wow. Okay, that puts costs into perspective.
It has absolutely staggering implications. Let's take an example. It's kind of shocking. Imagine an investor, pretty conservative, 50% passive stocks, 50% bonds, all index funds, low cost. Let's say they expect about a 6% net return after costs.
Okay, 50-50, 6% net. Seems reasonable.
Now compare that to someone more aggressive. They go 75% stocks, 25% bonds. But their stocks are in active funds charging that 2% fee we talked about.
Okay, so more stocks should mean higher returns.
Yeah. Think. But that 2% fee drag pulls their total expected return down to only 5%.
Wait, seriously? The conservative 50-50 person makes 6%. The aggressive 725 person makes 5%.
Exactly. The indexer earns 20% more return, even though they took on arguably less risk, only 50% stocks versus 75%, all because they cut out those costs. The math is just brutal for high-cost active management.
So it just keeps coming back to keeping it simple, keeping costs down. We know we should start early, minimize costs, minimize taxes, diversify. Index funds do that diversification automatically, right? They eliminate the risk of picking the wrong stock or the wrong manager.
Precisely. You're left only with market risk, which you get paid to take, hopefully. And, to wrap up, there's this great quote from the economist Paul Samuelson. He won a Nobel Prize. He said, "The creation of the first index fund." He compared it to the invention of the wheel and the alphabet.
The wheel and the alphabet. That's a statement.
Yeah.
Comparing a financial product to those fundamental inventions. So maybe something for you, the listener, to think about. What modern invention, something maybe from your lifetime, do you think is truly analogous? What compares to the index fund's long-term, maybe revolutionary impact on financial well-being for ordinary people? Something to chew on.